No,
Sir,
first
hello.
PFRDA chairman, let him join, no?
Okay, so
Hello,
shall we
let us introduce each other.
Yeah. First of all, we shall be introducing. Sir, let us first, PFRDA chairman is supposed to join within a few minutes. Should we wait for that? I think we can wait for him. Then we can yes, sir has joined. Thank you, sir. Thank you. Namaskar. Sir, our honorable president is with us. Our vice president is with us. And our speaker is also with us. So I would request our official Indrakshi to start your program.
Okay, sir. Good afternoon, everyone. The Banking, Financial Services and Insurance Board of the Institute of Cost Accountants of India is observing January 2024 as the Retirement Solutions Month. And today we are organizing in association with PFRDA the second webinar on the topic Retirement and Eventual Reality. And we are really privileged to have with us as our special guest of honor, Dr. Deepak Mohanty, who is the chairperson, PFRDA. We welcome you, sir. Guest of honor and speaker, Sri Pankaj Mathwal, sir, is the founder and managing director, Optima Money Managers Private Limited. Our speaker, sir, CMA Shomit Das, sir, he is the chief mentor, financial goal achiever. Sri Shumit Kumar, sir, he is the CGM PFRDA. From the institute, we are really honored to have with us our president, sir, CMA Ashwin Ji Dalwari, sir. We welcome you, sir. Our vice president, sir, CMA Bibhuti Bhushan Naik, sir. We welcome you, sir. Our chairman, sir, CMA Chitturanjan Chattopadhyay, sir. CMA Dibyendu Roy, sir, additional director and HOD of the BFSI board, and other official dignitaries of BFSIB. So we welcome all of you. So we start the program with our institute anthem.
असतो मा सद्गमया तमसो मा ज्योतिर्गमया मृत्युर्मामृतं गमया मा सद्गमया तमसो मा ज्योतिर्गमया मृत्युर्मामृतं गमया असतो मा सद्गमया तमसो मा ज्योतिर्गमया मृत्युर्मामृतं गमया ॐ शान्ति शान्ति शान्ति.
So thank you, Indrakshi. Good evening to all of you. First, I will wish Happy New Year 2024 to all the dignitaries. The BFSI board of ICMI in association with PFRDA is organizing today's webinar titled Retirement and Eventual Reality in the Retirement Solution Month observed by the Institute in January 2024. We welcome Dr. Deepak Mohanty, Chairman PFRDA, for gracing today's occasion as a special guest of honor. We also welcome Sri Pankaj Mathwal, Founder and Managing Director, Optima Money Managers Private Limited, who is the guest of honor and speaker. We also welcome CMA Shomit Das, Chief Mentor, Financial Goal Achievers, who is also a speaker for today's webinar. We welcome Sri Sumit Kumar, CGM PFRDA, and other officials of PFRDA for today's event. We also welcome our Honorable President CMA Ashwin Ji Dalwadi, sir, and also our Vice President Honorable CMA Bibhuti Bhushan Naik, sir, and also our Honorable Chairman BFSIB CMA Chitturanjan Chattopadhyay, sir. We hope today's webinar a very grand success. Over to you, Indrakshi.
Thank you, sir. So I would request now our chairman, sir, CMA Chitturanjan Chattopadhyay, sir, for his address.
Thank you, Indrakshi ma'am. Very good afternoon to you all. I welcome you all to this grand, this program on retirement solution month, and I especially welcome you all in this very day, which is the customer service day, which is being observed all over the world as a customer service day. So we are very happy to host this program for the citizens of this country and our members who are here today, and they are all observing it from India and abroad. I am very much grateful to my president and vice president for having this sort of program. They are supporting this program in a very big way. And I am very much thankful to PFRDA, especially Chairman Dr. Deepak Mohanty, whom I have met, and he has immediately accepted our invitations as today's chief guest. I am also thankful to Mr. Pankaj Mathwal, CEO of Optima Money Managers, as the keynote speaker, and our own CMS Somit Das, who has always been with us as a resource person. He is the chief mentor for financial goal achievers. And especially, I must give thanks to Mr. Sumit Kumar, who is CGM of PFRDA, who has been the main, he is instrumental for bridging with PFRDA and our ICMI. We know that once we start our job and profession, and eventual reality is that is retirement, which obviously come to all our lives. We should accumulate our savings and imbibe the habit of wealth creation, which will serve our retirement, so that we do not run down or run out of our own funds in our silver years. The effective planning from the day we start earning is the secret for a happy and prosperous retirement. We know that the average lifespan is increasing due to advancement in medical science, but working is also limited. So in order to bridge the deficit, we need to plan effectively in our working hours. In fact, keeping this in mind, we have started this observing this January month as a pension month, when we have got this is the third consecutive year we are doing. We have in our program Dr. Bhagavat Karat, Honorable Minister of State or Minister of Finance in 2022. He was one of our very esteemed guests. And of course, the PFRDA chairperson, Diren Times, Sri Supratim Bandopadhyay, also present in our physical event at Kolkata in January 2023. Now, my friends, many retirement solutions are there, which are there like NPS, APY, annuity schemes, retirement mutual funds, ULIP, insurance products. So every product has got their strengths, and I hope today itself many students have joined, many young CMAs have joined, and I hope that all youngsters should plan early so that they can benefit the virtues of compounding. If we fail to plan, we plan to fail, and inculcating the savings habit and investing for long term is the secret for effective wealth creation. And definitely our chapters are also organizing. It's a very encouraging for us that our chairman of the PFRDA has become very much instrumental in advising us, and our president sir has always given us this belief that we have to reach to the unreached. This particular NPS and others, whatever will be there, I'm hopeful that our speakers will also be delving on the various facets of NPS today. And with this, I wish you all wonderful and valuable session from our expert. Thank you.
Thank you so much, sir. So I would request now our Vice President, Sir CMA Bibhuti Bhushan Naik, sir, for his address.
Good afternoon. Thank you, madam. Outside, I am extending my thanks to our chairman of this committee, BFSIB committee, Chitranjan sir, Honorable Chief Guest, Deepak ji, Honorable President of our institute, Dalwadi sir, Pankaj ji, Somit ji, and others who are there, and distinguished members and students who are attending. It's a very good topic, relevant, the retirement and eventual reality. So many aspects are there. Financial aspects is the major aspect after retirement planning. Along with health is there. Infrastructure planning also. And any other aspect. Nowadays, life is very critical. And after retirement, also it is very critical. Before retirement, when we are teaching to our students, those who are continuing our courses regarding pension. We are giving knowledge that pension, commuted pension, uncommuted pension. When one should opt for commuted pension, when one should opt for uncommuted pension. The pension, government pension or any other pension also, there is provision of commutation and uncommuted pension. Because there is risk. After retirement, there is risk. Risk of everything. Social risk and financial risk and life risk also there. So I am expecting this session from the experts, Samit ji and Pankaj ji. They will put some light on this topic so that today's session will be very fruitful and realistic also. That like our retirement and eventual reality. So I hope this program, this program will be very successful. Thank you very much. Okay.
Thank you so much, sir. So I would request now our President, sir, CMA Ashwin Ji Dalwadi, sir, for his address. Sir, please.
Thank you, Madam. Honorable Chief Guest Deepak Mohanty Ji, Honorable Guest of Honor and Keynote Speaker Pankaj Mathapal, Founder and Managing Director of Optima Money Managers Private Limited, Speakers Sri Soumit Das and Sumit Kumar, CGM, PFRDA and other officials of PFRDA and our institute. My colleague in the council, CMA Chittaranjan Chattopadhyay ji, Chairman BFSIB of Institute, distinguished members and participants. BFSIB is regularly organizing several programs, and according to me, in our institute, it is leading as far as the programs, organizing of the programs is concerned. BFSIB is also organizing since last 3 years, the pension month in the month of January and retirement solutions in association with PFRDA. Similarly, it is also organizing webinars, seminars, courses and representation letters and other activities to government and other authorities for the growth of profession. Living longer is a reality of the current days. See, earlier in 1930s, our Indians life expectancy was around 30 to 35 years. Now it has grown up to 72.42 years. And for surviving after earning years, there is a need for flow of a regular income. Actually, retirement is an eventuality. It is a fact and situation where your expenses continue, but your income is stopped. Effective planning is required to enable and ensure that income flow continues even after the retirement to meet the flow of expenses. The planning process should start early at the age when we get our initial income. Basically, retirement planning is comprising of 5 or 6 areas where I would just simply touch upon. One of them is financial planning, retirement age trends. See, it is said that nowadays, a person who wants to be a manager or senior manager, he has to learn or he has to go to the college at least for up to the age of 28. By 32, he becomes a manager, and by 42, he is either tired or retired. This is the actual scenario in the dynamic world. And right now, you see the eventuality and issues pertaining to AI, because a lot of people may lose their job at very young age. So retirement age trend is also very important, and you have to choose that appropriately. Another is area is health and wellness. How is your health? How you are well depends on your financial planning and retirement age planning. Lifestyle of choices. How would you like to stay, live after your retirement and at present also? That also affects your retirement planning. And workforce trends. That means I already referred at retirement age trends that the because of invent of the technology in certain areas, the jobs are losing their importance, and many people may become jobless at early age. So that is also a factor. Of course, government is also knowing this part and is also running several programs and having a good policies. So I'm sure that today uh, in this program, the speakers will deal with these areas. And I would like to add only one thing. NPS is a wonderful product of PFRDA, which enables the flow of income through annuities at the time a person reaches the age of senior citizen. But this may not be sufficient in the current age. So we need diversified financial planning and planning at from the early stage also. So I congratulate BFSI department in organizing more this kind of webinars, and I request them to go for more and more such programs at regional level and chapter levels. Thank you all. Thank you.
Thank you so much, sir. Thank you so much for such an inspirational address. So, I would like to now introduce our special guest of honor, Dr. Deepak Mohanty, sir. না বললাম বড় করে দাও এটাকে। এটাকে বড় করে, হ্যাঁ, এইটাকে, হ্যাঁ। So, Dr. Deepak Mohanty, sir, he has assumed charge as chairperson, Pension Fund Regulatory and Development Authority, PFRDA, on 20th March 2023. Sir is an economist with substantive policy experience. Earlier, he was Chief Economic Advisor, Federation of Indian Chambers of Commerce and Industry, and was an independent director on a few companies' boards. Prior to that, Dr. Mohanty was whole-time member PFRDA. He served as Executive Director of the Reserve Bank of India, overseeing areas of enforcement of banking regulation, risk management, internal audit and inspection, financial stability, monetary policy, economic research and statistics. He served as Executive Director of the Reserve Bank of India, overseeing areas of enforcement of banking regulation, risk management, internal audit, and inspection, financial stability, monetary policy, economic research and statistics. He has also worked as senior advisor at the International Monetary Fund and earlier worked in various positions in economic research and was head of the monetary policy department in the RBI. He has chaired several committees. He has several publications in professional journals, edited 2 books, and has delivered several speeches on macroeconomy and monetary issues. He has a doctorate and 2 master's degrees in economics. We welcome you, sir. So now requesting our special guest of honor, Dr. Deepak Mohanty, sir, for his address. Sir, please.
Good evening. Am I audible?
Yes, sir, you're audible.
President, Institute of Cost Accountants of India, Vice President, BFSI Chair, and all the dignitaries and esteemed invitees and participants. I extend a hearty welcome to all of you to this interaction. Of course, we have also a panel of speakers who will also be speaking. And first of all, my gratitude and thanks to the Institute of this thoughtful gesture that this month is being celebrated as a pension month, the whole month of January. And coming from a professional body like yours, so it will certainly add value and help to the effort that is being undertaken. And I also thank the Institute for your kind invite to me and my colleagues for the program. Retirement is a certainty. If we are employed in a formal sector, there's a particular retirement age, so that happens. If somebody is self-employed, professional and all that, and sometime or other, that you have to leave active work. So that is how it happens. When people ask me that when we should have done the retirement planning, I said that we could have done it yesterday. So it's too late. So there is a merit in starting early in life. And since you are a professional body, then you would certainly realize that the power of compounding. Small amounts squirreled away at a younger age, even one is a student, you can do that, and a little bit of money one puts there. So that adds up to a substantial corpus at a time when one really planning to retire or just wants to hang their boot for from the active work, and so that is important. And compounding really happens. You are towards the last part of cycle, because since I have gray hair, when as youngsters we are putting money in, the provident fund that we'll have, is so that it's a small amount. What is going to fetch up, so many years down the line. But for the end, when you retire with a good corpus. The compounding really happens toward the last part. So staying power is important. Because one thing to realize that this is a retirement fund, then one really would have to stay through that process. Then coming to the reality of our demography. See, among various factors, one dynamic factor that we have, that we are the most populous country on the face of this planet, and we are the youngest country. So that's what it is. The youngsters, the share of working age population is very, very high. It is the highest. So that is what, apart from other things, is adding dynamism to the economy, and there's so much optimism around as we aspire to, to become a high-income country by the middle of the century. But for sure, this population is going to, But for sure, this population is also going to age. That if you see now, that every 10th person in the workforce, means in our population, is more than 65 years of age. This will become rise to 20. That means 1/5 of our population by 2050 would be over 65 years. So obviously this adds a lot of burden on the whole system. And the preparation for that has to begin now, because at that point we should not be stirring for idea that what should be done. So the provision really has to be made, and it is appropriate because now we have a young population. And this is the working age and earning age, so they can set aside money and plan for the retirement. The other myth, people, I think President also mentioned this, that people think that, I have one retirement savings account, whatever, suppose the employer gives a provident fund or whatever it is, that is enough. It is not enough. The compelling narrative globally, it is because we are a developing economy, even if you take advanced economy, is old age poverty. So it is easier said than done, that people think that, they will change their lifestyle post-retirement, but, post-retirement, the expenditure is not really going to rise, and particularly the healthcare cost and other things also would really increase. So one is not enough. If you look at advanced countries, so they would have at least access to 3 retirement products. One is the state given, some minimum social security pension, and they would have some kind of occupational pension, employer-employee kind of relationship, and people would have their personal plans also. 3 put together is not enough. So how can one, product be enough? So that's what I'm saying. To the youngsters and others, they may think that they're in employment, somebody gets NPS, somebody gets provident fund, and all that's enough. That is not. So one really would have to aim at multiple products in terms of retirement. And the other aspect is that there is no substitute for a fixed stream of income and a certain stream of income coming out. That means it is a pension, or you can say it is an annuity. It is kind of an annuity. It comes, and so it stays with you and goes with you. Means you stay with with somebody till their demise. Then it can pass on to the spouse or something like that. So it doesn't leave you. People think that they can manage money well, so they retire with a pot of money, which they would have seen earlier. I'm saying for a normal salaried person, and the management, and then you have money illusion. You say, oh, I have seen things in thousands or lakhs, but if I get a crore, which then it is going to last me forever. But the stories that we hear, people retiring with a lot of money, no sooner than you would expect, they have run out of that money, because there are always competing demands coming out of that, and it comes from every sources, even including your families. Without realizing what is happening, that money really runs out. So once it is in a pension or kind of in a fixed stream, that it is in fact logged in, and nobody can really take it away as long as you leave. So that's the kind of advantage. So in this context, if you look at pension, that people who have gray hair would testify that. See, earlier among the citizen or retired people, what distinguishes a government servant from the other, they say, oh, he has a pension. So he or she was the envy of the locality, because they have a pension. Others didn't have. So now with NPS, which actually started for the government employees post 2004, and since 2009 is made available to everybody. A common person can also access NPS with similar kind of a feature. So that is what it is. So the pension has been socialized in this whole process, and one really should take advantage of that. Then let's look at how that will come. Then let's look at the labor force and the employment scenario. That if you see, There are always debate discussion on how many people are in the organized sector, how many are not, but certainly more than 80% people are in the unorganized sector. So there is no statutory access to any post-retirement fund, any post-retirement benefit. So people really would have to, fend for themselves and provide for themselves. I'm not saying that people who cannot really afford, but I'm also talking about professionals, small businesses. People are there, they can afford when they're young, when they're in the work. But what about post, retirement? That how to get that particular kind of income. So that provision really would have to be made. The other thing would be gender. Because if you see longevity, it was mentioned by the president that our longevity is increasing because life expectancy was 35 years into 1950, and if you go to 2050, currently it's more than 70, and that's also going to increase as we see in the advanced country. And somebody lives up to 65. And one can add on another 15 to 16 years into the life expectancy that one is getting into, say, 80s, I'm saying, on an average. So this is the kind of a situation which is there. So provision really would have to be made on this. So NPS has become accessible to all. It is available in two modes that one can do straight on the online method. Because there is the eNPS. People who are little savvy and can do a little bit of technology to access that process, they can on their own can really access NPS. Those who cannot, there are intermediaries. What we say the points of presence, because that if you see that any bank, your bank, everybody has a bank account. So you turn to your bank, so they are also a point of presence. So they can also offer NPS on that side. So I would suggest that it is necessary that one takes an NPS. It is necessary that one takes NPS, meaning is a pension product, in addition to other things that they may have. So that is how it has to be done. And what is the advantage of NPS? Is that it is portable. Since I am talking to professionals, and it was also mentioned that the working period which was there and the mobility which was there earlier was restricted, was limited. The opportunities were not there. You join a particular company or a particular organization, you spend your whole life almost there. But now youngsters hop from job to job, and staying span is also very, very limited. And you can also choose to pursue your own interest and other professions in between, so you can have a discontinuity. But NPS is something that seamlessly it can progress. If you jump from employer to employer, so you can continue the same NPS plan, whatever we say the number, unique number that one has, can continue. And it is also status neutral. Whether one is employed, one is not employed, unemployed. So continuity. So that means a retirement plan through NPS can have a continuity. For example, if I have to give that in case of provident fund, unless EPFO, so unless you are in a formal employment, you don't get that continuity in that whole process. So this is one. It was also mentioned that there are members who are abroad internationally. Youngsters also hop from one job to other. It is a less known feature of NPS that NPS is also available for NRIs, non-resident Indians. That for a short period, that if you are going abroad, going for a stint of employment outside, one can really continue NPS and then come back and continue on that process. So it is a portable scheme. The other thing would be that it gives a whole lot of choice. Because people, it is not easy, since you are finance professionals, it is not easy to make a choice in terms of investment. But those who cannot make that choice, because we have a life cycle fund, which is a default fund, so people can go choose life cycle. meaning that the equity component is brought down as one really ages in terms of years, and the debt component goes up in that process because the risk tolerance to that extent it comes down. And but those who can make a choice for themselves, so obviously you can make a cocktail of that, debt, equity, and how much it can really be done, how much of a equity, how much of a debt. Obviously, somebody at a younger age should do more equity, and in that sense, that what we've allowed, that full equity means 75% can really be put in equity, balance 25% in a debt component. And debt component, that what we see that it is again government securities. So obviously, you don't have any credit risk. And when it is the corporate securities, it is mostly over 95% in AAA rated bond. So there is a lot of certainty in terms of kind of investment because it's a regulated investment. The other aspect is a low cost fund. So that means the pension funds who professionally manage these funds, so they are remunerated on an average 0.047%. And you compare with the other products in the market and it's at a low cost. Then who gets the benefit? The benefit really passed on to the ultimate subscriber. So a subscriber becomes benefit. And this is reflected. For example, that if we look at equity funds since inception, it gives an annual return of over 13%. Currently, it is around 13.3, 13.4%. Let's look at a composite scheme of debt and equity, and good example is that of the central government scheme, where the central government employees contribute. And there, since inception, return is 9.4% per annum. So please compare that with other products in the market. So obviously, you will see that this is kind of a competitive return. So return is very good. These are regulated funds. So this should be a kind of a natural choice. But people really readily don't go in for this. Partly lack of understanding and knowledge and financial literacy in the country is also low. And globally, also financial literacy is low. Because we have numeracy or literacy, that doesn't mean one is financially literate in that sense. Though financial literacy is relatively low, even pension literacy would be even worse from there. Because pension is the last thing in one's mind, because when you are young, you never think that you'll retire and this kind of requirement would be there. So that is how, but actually, in fact, it doesn't work. Now, finally, it becomes a question of affordability. You would say it's a contributory scheme. Though always there's a competing demand, some people can really set aside surplus and put it for, in the retirement planning, but others may not. But we are a lower middle income country in the sense that we are about 2,300, 2,400 per capita income and aspiring to be a high income country. For sure, sometime during next decade, it depends that how the GDP is expanding, will become an upper middle income country. Okay, so this should be like 4,000 plus US dollar per capita income. That will be that bracket. So obviously, people would start looking beyond their daily necessities. So the affordability is going to increase. And so with the right knowledge, people really should be moving into this, and then of course we aim for a high income country. And this is no rocket science. If you look at the entire corpus that we have in terms of pension kitty, means including everything, NPS and EPFO corpus and all that put together. So that's about 16.5% of GDP. If you look at the OECD countries, so the average is about 80% of GDP. There are countries like Scandinavian countries, if you see that the pension corpus is more than 200% of the GDP. So obviously there is a scope. Obviously there is an example that everybody is doing it, and we necessarily would have to really do that. So there is a whole lot of scope which is there. But what we see that the take-up rate, because we see a lot of corporates coming in, the take-up rate by the employees are low, because we have about 19 lakh NPS subscribers, though we have about 15,000 corporates who have joined. And but all citizens model, as I said, that it is also to the private, anybody can join. So that's little higher. That's about 32, 33 lakh people join on that side. I'm setting aside the government necessarily would have to come in. So these numbers are really very low. I think with more knowledge and more outreach and efforts from institute like yours, it would extremely be good for the scheme, that we should have more and more people thinking about retirement planning and joining something like NPS. So thank you for this opportunity.
Thank you so much, sir. Thank you so much.
Thank you, sir.
So,
thank you, sir, for your encouraging speech. Definitely, our institute will be always handholding PFRDA for reaching to the unreached, and we have already started, many programs on this. And as our Honorable President has already told you that he has also advised us, so we'll be reaching in our chapter network. Through this network, we shall be definitely propagating this particular NPS. And I request your officials to also support us so that we can reach to the unreached, sir. Thank you, sir. Thank you.
Yeah, absolutely. All support is there from our side, and any literature and all that is required, and so that we can certainly provide.
Thank you, sir. Thank you.
thank you so much, sir. So I would like to now introduce our speaker, CMA Shomit Dash, sir, Chief Mentor, Financial Goal Achievers. Sir is a qualified finance professional with over 25 years of experience in financial planning, risk management, and treasury management functions of media and entertainment, defense and aerospace, and FMCG industries. He has worked in leading multinational and Indian companies like ESPN, Star Sports, Star TV, Bharat Electronics Limited, and Hindustan Unilever Limited. He is the founder and chief mentor, Financial Goal Achievers. He advises clients on investment planning, retirement and tax planning, and risk and estate planning solutions. He is a specialist in asset allocation across stock, bond, cash, gold, and property. His advisory products include life insurance, general insurance, fixed income, pension, annuity, NPS, stocks, bonds, private equity, and many more. He publishes articles on personal finance in finance journals, speaks on personal finance in FM radio shows. He conducts webinars and social media shows on personal finance for finance professionals and investors. So we welcome you, sir. So now requesting CMA Shobit Dash, sir, for his address.
Am I audible?
Yes, sir, you're audible.
Is my screen visible?
Yes, sir. Yes, sir.
Retirement planning solution.
Yes.
Thank you, ma'am, for the wonderful introduction. Welcome all to this exclusive webinar on retirement and eventual reality. It's an honor and privilege to be speaking in such a august gathering, which includes special guest of honor, Dr. Deepak Mohanty, Chairperson, PFRDA, guest of honor and speaker, Sri Pankaj Matpal, founder and managing director, Optima Money Managers, CMA Ashwinji Dalwadi, President ICMAI, CMA Bibhuti Bhushan Nayak, Vice President ICMI, CMA Chittaranjan Chattopadhyay, Chairman BFSI, Board of ICMI. So I am Shomit Das, a financial planner based in Mumbai. And I help, I'm founder of Financial Goal Achievers, which is a boutique consulting firm that specializes in financial planning, risk management, wealth creation, and treasury management solutions. We are a group of finance professionals committed to build a society wherein every individual would experience financial freedom. We help our clients to make smart investment decisions through solid relationships founded on uncompromising integrity, trust, and personalized services. So in the next 30 minutes, I'll take you through retirement planning. Retirement planning is actually lifelong cash flow planning. Let me set the context through a concept which I've learned from one of my financial coaches, Dr. Sanjay Tulani, who's based out of Dubai and who travels the whole world to train financial planners like us. Now, this concept is called 28K circle of life or 28,000 circle of life. Now, what is this 28,000? 28,000 is actually the average number of days a human being lives on this earth. Now, if we divide that 28,000 by 365 days, we get an average of 76.77 years. If we round it off to the nearest multiple of 10, we get 80 years. So on an average, a human being lives for 80 years. Now, this 80 years, let's divide it into 4 quadrants or 4 phases. The first one being 0 to 20. This is the phase when we study, play, fool around, and this part, our expenses associated with this phase is sponsored or taken care of by our parents. The next phase is 20 to 40, wherein we complete our studies and get into our first job, we buy our first car, we buy our first house, get married, and have kids. Then we get into the third phase, which is 40 to 60. And during this phase, we take up a second job or start a business of our own to supplement the additional income that we need or additional expenses that we are having. We buy a second car because the first one we have been driving over the years have turned into a piece of a junk by now. Invest in a second home, buy a second home primarily for investment purpose. But this is also the time when our kids are growing up to enter into the second phase. Then we get into it is during this third phase, there are 4 universal questions which haunts all of us. Now, the first question is, what if I cannot work till 60? What if I meet with an accident or I am taken over by a bad disease, a critical illness? Well, this question can be answered by taking a suitable and adequate accident insurance, suitable and adequate critical insurance plan, which is a contingent cover, and a suitable, of course, the most important these days is a health insurance cover. The second question is, what if I don't reach till 60? What if I die? This question can also be answered by a solution called life insurance. Life insurance actually ensures continuity of income with a suitable corpus being made available in case I am not with my family and dependents tomorrow. The third question which haunts us is, how much is enough to retire? Well, the answer to this question will vary from individual to individual based on their earnings, based on their lifestyle, and other factors. And the fourth question is, can I ensure that my children start life with the right foundation? And most of us may unanimously agree that the best foundation we can give to our children is the right education, and which, of course, higher education these days comes at a cost. And then we get into the final phase, which is 60 to 80, which is the retirement phase or the fourth phase. And this is where there is no income. So if we look at the span of 28,000 days, we actually earn only 14,000 days, and balance 14,000 days we don't earn. And out of this, the most critical is the last 7,000 days, which is 60 to 80 years. And we need to make adequate provision for ourselves to build up a healthy retirement corpus so that will last for 7,000 days at least. Why I wanted to share the concept is the importance of time. For an investment decision, for a retirement planning, what is most critical is the time and how early we start. Retirement planning is based on the three pillars of financial planning: provision for emergency funds, provision for lifelong earnings, and provision to beat inflation. Another one of my favorite quotes from George Foreman is, it's actually a different perspective of looking at retirement. The question isn't at what age I want to retire, it's at what income. George Foreman had been an American boxer, two-time world heavyweight champions, an Olympic gold medalist, and he had gone on to become a minister from Texas, USA, and is also an author. I would also like to share with you another quotation which will also give us a food for thought. This is by a Canadian prosperity coach and author, Ernie Zelinsky. Plan an enjoyable second innings. Your best retirement plan for retiring happy and prosperous. Don't be a burden on others. Live a life of dignity and self-respect till the last day we live. So we need to plan for it. Some of the common financial mistakes many of us make in the initial part of our career is, at the age of 20, we have no planning for retirement, avoid investing. At the age of 30, there is unorganized savings, improper financial planning, buying flashy things. At the age of 40, we are burdened by loans, no thought about writing will. At the age of 50, we are dipping into our retirement savings, not realizing retirement costs. Retirement planning is the process of building a healthy retirement corpus of diversified asset classes for the investor that can generate free cash flows for whole life of the investors required to lead a comfortable retired life at their own terms. Again, a life of dignity and self-respect while we play our second innings well. Why is retirement planning so important? It is because the increase in life expectancy with the advancement in medicine, we adopting healthy habits like healthy food, exercise, dependency ratio, no proper financial security, social security, decline in joint family structure, and inflationary pressures. The risk of living long is actually the cost goes up. Check out your monthly expense when you retire. It could be 4 times your current monthly expenses if we take inflation rate of around 6%. So if the present expense is 30,000 per month and we are in the age of 25 years from now, at the age of 60, the same cost will become 1,20,000. So our retirement planning should not be based on our present expenses, but it should factor in the inflation, and it should be healthy enough to meet the expenses 25 years fast forward. Things which we say should ideally happen at retirement. A retired person should be owner of his or her house. A retired person should have adequate health insurance cover. This health insurance cover not only should be quite healthy in terms of the sum insured, but it should also cover issues and illnesses which are associated with geriatrics, like critical illness and something which is related to pain relief. So all those special health needs to get covered. And we need a cell phone home because we need a shelter till the day we leave. A retired person's major liabilities should be closed. We should plan all our loans so that we can close it much ahead of our retirement. Retired person should create an emergency fund to meet any contingency. The first contingency which comes to the mind is the health emergency. So, we are all aware that in case of a hospitalization, not all the costs are covered by the health insurance. Or there may be a situation where your hospital to which you are going is not covered under the PPN network or preferred partner network. So you have to pay for the expenses of your medical treatment and then claim to the insurance company. So you need to have available funds to do that. And that this should be in a liquid fund or a fund which can be easily liquidated. Retired person should create a healthy retirement corpus for steady flow of money for whole life. Retirement planning cycle consists of 3 phases: wealth accumulation during the earning years, wealth distribution during the retirement years, and estate transfer upon death. And that brings me to my favorite retirement planning product, which is the National Pension System, or NPS. ET Wealth recently did a survey and assessed 10 tax saving options on 8 parameters: returns, safety, flexibility, liquidity, costs, transparency, ease of investing, taxability of income. And the National Pension System, or NPS, has been voted the top tax saver for the second year in a row. The National Pension System was introduced by the Government of India for central government employees joining services with effect from 1st January 2004. 5 years later, on 1st May 2009, on voluntary basis, NPS was made available for all citizens of India. PFRDA was created as regulator for the pension sector. NPS is based on personal retirement accounts created for individual members. NPS accretes savings into the subscriber's PRA while he or she is working and use the accumulations at retirement to procure a pension for the rest of their lives. Let's understand the NPS ecosystem. Now, the NPS ecosystem consists of various functionaries and service provider under the architecture. To start with, there is a POP, or point of presence, whose role is opening of accounts and receiving contributions. As on date, there are over 336 POP, or point of presence functionaries, which largely consists of banks, which includes PSU banks, private sector banks, cooperative banks, broking houses, NBFCs, and the list goes on. The second functionary which comes is the PFM, or the pension fund manager, who are responsible for managing the retirement savings of the subscribers under NPS. As on date, there are 11 pension fund managers under the NPS system, and they include all the big pension fund managers, like which includes LIC Pension Fund, SBI Pension Fund, HDFC Pension Fund, ICICI Prudential Pension Fund. Then comes the functionary CRA, or the Central Record Keeping Agency, who are responsible for record keeping, administration, and customer service functions for all subscribers of NPS. As on date, there are 3 functionaries who are acting as Central Record Keeping Agencies. They are CAMS, KFintech, and Protein, who's erstwhile NSDL. Then comes the trustee bank, who facilitates fund transfers across various intermediaries of the NPS, from pension fund managers to annuity subscribers, annuity service providers to subscribers. As on date, Axis Bank is the trustee bank. Then comes the custodian, who are responsible for custody of the underlying assets bought by the pension fund managers. As on date, the custodian is Deutsche Bank AG. Then comes the annuity service provider, who are responsible for providing annuity service after subscriber exits from NPS. And as on date, there are 15 annuity service providers, which are largely life insurance companies, and they include all the big ones like LIC of India, SBI Life, HDFC Life, ICICI Prudential Life, and the list goes on. And at the top of all this is the NPS Trust, who are responsible for taking care of the funds under NPS by prudently monitoring, auditing the portfolio of pension fund managers on regular basis. Now, why NPS? It's a single plan with multiple benefits. Let's check out the features and benefits of NPS. NPS is portable. The subscriber can carry their NPS accounts across employers and across locations. NPS is a simple standard product regulated by PFRDA. NPS flexible. One can choose, or subscribers can choose, the fund manager, the investment options, and the annuity options. NPS is economical. It's the lowest cost investment product currently available in the market. NPS offers tax benefits. There are multiple tax benefits under the NPS system. These includes benefits under Section 80CCE, benefits under Section 80CC D1B, 80CC D2. And NPS is regulated by PFRDA RDA, who are regulator of NPS, and who are regularly monitoring pension funds by NPS Trust. Now, there are two types of accounts under NPS. Tier 1, which is the pension account, and Tier 2, which is the investment account. While Tier 1 is mandatory, Tier 2 is voluntary. Withdrawal from Tier 1 is restricted. Withdrawal from Tier 2 is flexible. Tax benefits under Tier 1 is there. There are no tax benefits under Tier 2. It's primarily an investment account. Account opening charges for Tier 1 is ₹500 and that of Tier 2 is 1,000. Annual contribution is as low as 1,000 for Tier 1 and only 250 for Tier 2. Investment account has the lowest fund manager cost, like 0.06, and the liquidity of funds is also very, very easy. There are multiple tax benefits under the NPS system. Number one is it reduces the taxable salary. NPS contribution by employer up to 10% of salary, which is basic plus DA, is deductible from the taxable income under Section 80cc D2. While there is a capping of 7.5 lakh on the contribution, which includes, apart from NPS, the superannuation funds and the provident fund also. The subscribers can claim tax deduction for the contribution to the NPS accounts. Deduction is available to the subscriber up to 50,000 under Section 80cc D1B and a deduction of up to 1,50,000 under 80cce. The fund options available under NPS are 4, and if we plot them in an axis of X and Y, which is returns versus risk, they are as follows: government securities, corporate bonds, equity, which of course has a limit of 75%. And with the progress of the age, it comes down, but up to 60 years, one can invest up to 75%, and alternate funds, which is 5%. Now, investment choices, a subscriber can opt for active investment choice, where they want to decide on the asset allocation between all the 4 funds which are available. We are popularly known as G, C, E, and A. And the subscriber decides the fund allocation under the active choice. And in auto choice, the investment choice is based on life cycle and the risk profile of the subscriber. Equity exposure, as I said, under active choice is up to 75%. And in case of alternate assets, this is 5%. The 3 investment options or the risk profile under auto choice are aggressive, which offers equity allocation of up to 75%, moderate, which offers equity allocation of up to 50%, and conservative, which offers equity allocation of up to 25%. Exit from NPS. The vesting criteria are upon normal superannuation, that is 60 years, one can withdraw maximum 60% is paid as a lump sum to the subscriber, which is absolutely tax-free. The other 40% or minimum 40% of the NPS corpus should be annuitized. That is, that amount should be used to purchase an annuity to enjoy lifelong cash flow. If the corpus is less than 5 lakhs, then full withdrawal is permitted. Then exit from NPS before the normal superannuation, which is voluntary retirement, which is allowed after 5 years of NPS account opening. Minimum 80% of the NPS corpus should be annuitized. Maximum 20% is paid as a lump sum to the subscriber, and it is tax-free. If the corpus is less than 2.5 lakhs, then full withdrawal is permitted. Upon death, NPS corpus 100% is paid to the nominee or legal heir of the subscriber. And with a unique option, the nominee can choose to take the annuity as well. This is hardly available, or this kind of choice is not available for any other investment product. Partial withdrawal under NPS, a subscriber can now withdraw up to 3 times from NPS corpus after completing 3 years in the system. Subscriber can withdraw 25% of the contribution made by them, excluding contribution made by employer and growth generated. adhering to the following conditions: education of self and children, marriage of children, due to critical illness of self, spouse, or children, construction or purchase of residential property, for starting a business. The National Pension System, or NPS, has got one of the least charges which are charged by POP, or point of presence intermediary, and the Central Record Agency. And roughly it comes to around 500 at the time of initial subscriber, and very, very nominal charges. The schedule of charges are here for you to see. The magic of wealth creation lies in compounding. In order to gain the benefit of compounding, one has to remain invested. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. I think while in school, all the maths that we have learned, the one which is very, very relevant for wealth creation is compound interest formula, and sharing the same with you, that same A equal to P into 1 plus R to the power N, where P is the invested amount and R is the rate and N is the time. Time is the most important. Time in the market is more important than timing the market. The taste of the pudding is in the eating. Just look at the awesome magic of compounding. If we are investing in a systematic manner, only 5,000 rupees per month, and which is giving a compounded annual return of 15%, in the first year we get only 9% gain. But as and when time progresses, in the fifth year, we get a gain of 49%. Now here we have taken 15% because 15% is the like a CAGR which is given by the Sensex over the last 30 years. So we have taken that for showcasing this example. After 10 years, that wealth gain is 132%. And after 15 years, that is a whooping 276%. Let me share with you some aspects of the portfolio returns. Like, it is thought-provoking that asset allocation is responsible for about 91.5% of the portfolio returns depends on asset allocation. 2.1% of the portfolio returns depends on security selection. 1.8% of the portfolio returns depends on market timing. And all other factors are responsible to the extent of 4.6%. This is based on the research conducted. Now, what is important is the mindset that we have when we go to go out to have to make our investment. We must understand what are the controllable and uncontrollable factors in our investment journey. What we can control is risk, and what we rarely focus on. What we can control is cost. What we can control is time, and what we can control is behavior, but we rarely focus on them. We don't control, and what we only focus on is return. Retirement planning portfolio should be like this. Retirement is like a long vacation. One should enjoy life to the fullest without running out of money. So start planning for retirement today itself while you are earning. Your retirement planning portfolio should consist of income generating assets that largely includes pension and annuity plans. The advantage of pension and annuity plans, and which is a must-have in a retirement planning basket, is because it provides certainty of income throughout our life, and it ensures capital protection of our investment. The second one is government and safe corporate bonds. Like, at the fag end of our career, we would not like to get into risky investments. And what is most important is the protection of capital and correct returns as per market condition. Life insurance plans that generates tax-free cash flows. The beauty about endowment plans of life insurance, some of them generates cash flow throughout whole life, but at the same time, it is tax-free because of the tax benefit available for life insurance maturity under Section 1010D of the Income Tax Act. it should our retirement basket should also consist of diversified portfolio of mutual funds, and ideally we recommend hybrid funds, balanced advantage funds, which move the assets from equity to debt based on the equity valuation index of the market. Multi-asset funds or dynamic asset allocation funds, which includes not only debt but also includes gold to hedge the products. And if you are investing in a systematic manner and over a longer period of time, they can give you fantastic returns. And always remember that withdrawal rule should be 4% of the corpus. 4% withdrawal rule is the golden rule of retirement planning. And between the choice of dividend plan and a systematic withdrawal is more tax efficient and is always recommended, because in a dividend plan you have to pay tax at the marginal rates, that is the slab to which you belong. That is, if you are in the highest tax bracket, around 35%. But the same thing, and if you are opting for the dividend plan of cash flow, then you have to pay 35%. But if you are opting for the systematic withdrawal plan, you will be liable to pay tax under the capital gains. And if it's a long-term capital gains, it's 10% only. So you will be having a tax advantage of 25%. Stocks, which is very close to our heart, but in the retirement basket, we should only having good quality stocks or dividend yielding stocks. A business which generates cash is a business we should be investing in. Now, we generally use a QGLP framework to do our stock selection. That is, as Peter Leach have said, don't look at the stock in isolation. Look at the business behind the stock. So, like we recommend that one should be investing in stocks of companies which are into good business or great business, run by professional management, who are having growth in their earnings because of growth in market share, growth in their revenue, growth in their earnings and profit. The longevity of earnings should be there into the foreseeable future, and the price. We should always aim at buying good businesses at a fair price, which means that the intrinsic value of the stock should be higher than the market price. So I am buying a higher intrinsic value of a stock at a lower market price, which gives us the margin of safety. Do you know that Warren Buffett's Berkshire Hathaway, 70% of their portfolio is invested in only 4 stocks: Apple, Bank of America, American Express, and Coca-Cola. We should always focus on companies which generate good cash flows. It can include right from FMCG to energy to oil and gas to diversified companies. Real estate is something which is close to everyone's heart. More than 50% of the domestic household savings is invested in the real estate. But the problem is real estate is not a liquid asset, and the rental yields in India are still very, very muted. If we talk about the residential real estate, it is only average of 2%. And if we look at the commercial estate, real estate, the rental yields for commercial real estate is around 4%. Whereas the mortgage rates in India are still very high. It's around 9%. So if we have to go for a leveraged real estate, it is not at all a very, very attractive scene. If I have 1 crore to invest, rather than putting that money in a real estate and earning a very muted rental income of 2%, it would be worthwhile to invest the same amount in an annuity plan, a deferred annuity plan, or a pension, which will immediately give us a cash flow at the rate of around 7%. If your asset doesn't generate income, just replace it. Such focused approach will enable you to enjoy enjoyable second innings and to pay for all your expenses during your golden years. Now, estate planning is very important, comes as a part or corollary to the retirement planning. Did you know how much money is lying unclaimed in physical and financial assets due to absence of any legal claimant or beneficiary? Some of the recent numbers says that it's more than 50,000 crore. Don't let this happen to you by choosing estate planning. Estate planning is a process of anticipating and arranging during a person's life for management and disposal of the person's estate in the event the person becomes incapacitated and after death. This can be done through will, trust, power of attorney, healthcare directives, beneficiary designations. I would just like to show one slide on holistic investing. Invest in yourself, invest in your relationships, invest in spiritualism. I would like to conclude my presentation or talk with the serenity prayer. God, grant me the serenity to accept the things I cannot change, courage to change the things I can, and wisdom to know the difference. Thank you so much for being a wonderful audience.
Thank you, sir. Thank you so much, sir, for such an elaborate and vivid presentation. So now introducing our guest of honor and speaker, Pankaj Matpal, sir. He is the MD and CEO, Optima Money Managers Private Limited. Pankaj Matpal, sir, with over 30 years of experience, he is serving as MD and CEO of Optima Money Managers, the firm that manages the wealth of high net worth individuals. He regularly features as an expert on various national TV channels and has also authored various articles on the subject related to personal finance. To spread awareness, he regularly conducts financial planning seminars for Indian defense and paramilitary forces across the country. Mr. Matpal, he is a postgraduate in the stream of business management and a fellow of the AAFM USA. He has earned the prestigious designation of Certified Financial Planner from the Financial Planning Standards Board. Sir has served for 2 consecutive terms as a director on the board of Financial Planning Standards Board India, and he is the General Secretary of the Society of Financial Planners. We welcome you, sir. So it's now requesting Pankaj Matpal, sir, for his address.
Thank you very much for the lovely introduction.
Thank you.
I hope I'm audible.
Yes, sir, you're audible.
Dr. Deepak Mohanty, Chairman PFRDA, CMA Ashwin G. Talwadi, President ICMAI, CMA Chitranjan Chattopadhyay, Chairman BFSI Board, CMA BB Naik, VP ICMAI, Financial Planner CMA Somit Das, and all the participants. It's an honor for me getting an opportunity as a speaker and as a guest of honor. And my means Mr. Somit Das has covered many things related to personal finance and financial planning. So I'll try to speak more about the retirement because when we discuss about retirement, there can be two things in mind. One, whether retirement is good or bad, because when we think about retirement, it comes in mind that a day when the income stops, but expenses continue. But at the same time, there's an opportunity because after retirement, we have a lot of time for ourselves. So I'll discuss these all things. Let me share my presentation here. So I hope the slide is, this presentation can be seen here.
Yes, sir.
Yeah. So, yeah, retirement is an eventual reality, that is a fact. But as I said, it can be a pleasure moment or it can be a good time, because if we plan well, so it means we retire from work and not from life. So only thing is that planning is required, and retirement is wonderful if you have two essentials: must to live on and must to live for. Must to live for, you have time, as I said in the beginning itself. When we work for money, a lot of responsibilities are there. But after retirement, the things which we could not do during our working years can be pursued, whether it's a pursuing hobby, going on a vacation. So only thing is that with a good planning, that is possible. And second part, that much to live on. So that is why when you plan well for much to live for, and you have sufficient money to live on, then definitely retirement phase could be a wonderful time. It could be a earn, we work. But the problem is inflation. See, that is why we say always that as planning, start for your financial planning, start for retirement planning. I was hearing to all the speakers, and Deepak Mohanty sir said, and I agree with him. Usually, what happens during initial years, we always think about other financial goals, and definitely those are equally important. But retirement planning, generally people think after 40, 45 years of age. And I'll explain later that why it makes better sense if you start early for retirement planning. See, inflation, we all understand, but some things are there in our hands, some things are not in our control. So if today I say 1 lakh rupees I have, but if I assume inflation of 6%, first thing I will try to highlight here. See, generally when we talk about headline inflation, 6%, 7%, but more we should focus on the individual inflation, on the individual things. For example, inflation in medical hospitalization, medical cost, inflation in education, inflation in consumption of consumer products, that may be higher than this. So even if I calculate at 6%, which generally we talk about the headline inflation, 6%, 7%. So 1 lakh rupees today will be something like 75,000 rupees after 5 years. Means the value of that 1 lakh rupees after 5 years will be something like, it is today 75,000 rupees. After 15 years, it will be something like 42,000. After 20 years, it will be something like 31,000. See, for last 15 years, I have been doing a lot of TV shows, means every day almost, I do 1 or 2 TV shows. And still, I get the same question that I want to accumulate 1 crore rupees for my retirement. I want to accumulate 1 crore rupee for my retirement after 20 years. Today, 1 crore, 2 crore may sound a good amount. But if you consider inflation, after 15, 20 years, the value of that 1 crore, 2 crore will be much lesser. If we apply the rule of 72, at 7%, every 10 years, your amount will be half. So, objective of explaining this is that earlier you start, better it is. Other way of looking at this expenses if suppose you spend 30,000 per month today, it's an example only. Somebody may spend 30,000, somebody may spend 3 lakh rupees. But for the purpose of calculation, if I say somebody spends 30,000 rupees today, and at 6% inflation, after 5 years, will need 40,000 rupees. After 15 years, the cost will be 72,000. And after 20 years, it will be 96,000. And I know that 30,000 is a very small amount. Even today, in general, if you see, the monthly household expenses are much more than this. It means that after 20, 30 years, when you retire, your monthly expenses will be multifolds, and story does not end here. The thing is, many times I hear this, that people say that I want X amount at my retirement. But suppose you retire from your work at the age of 60, and even you calculate, for example, you say that you will need 1 lakh rupees or 2 lakh rupees per month at the age of 60, but what about 65 years of age? What about at the age of 70 years? Because every year the cost will keep increasing. If you need 1 lakh rupee at the age of 60, after 30 years, after 20 years, whatever it is, after 10 years, after that, the expenses will be much higher. And we all expect to live longer. And the fact is, because of progress in medical science, advancement in technology, the life expectancy is increasing day by day. And for the young audience, I will emphasize on this, even if this time the life expectancy is say 74 years, but if a person is 30 years today, and for 20, 25 years, 30 years, means young people, they should expect the longer life expectancy. Because of advancement, as I said, in technology and medical science, longer. So longer will, so earlier you plan, better it is. See, one more slide I can present here. It is same like I did a calculation again at 7%. So 30 years of age, somebody spent 25,000 rupees. At 60 years of age, it will be per month expense will be 1,90,000. After 30 years. In the previous slides, we are talking about 15 years, 20 years. But if suppose 30 years old person is planning today.
Pankajji, your slide is not moving. Your slide is not moving, Pankajji.
No, is it now? No. Can you see this or no?
So we can see just the front, the first slide only. Other slides are not moving.
Oh, I'm sorry. Is it like this?
Yes, now it's moving.
Wait, then. Now?
Yes. Now it's okay.
I'm sorry. Extremely sorry then. Okay. So at 30 years of age, somebody is planning for 25,000 rupees, expense 25,000 rupees. At the age of 60, it will be 1,90,000 because there are 30 years time period between the age. So from 30 years to 60 years, if somebody is planning, because why I'm emphasizing on this thing, because in the audience, there are many young people. And usually I've seen this when we talk about the crore rupee, 1 crore, 2 crore, it looks very big today, but it may not be sufficient. So at the age of 70, because as I mentioned earlier also, somebody retires at the age of 60, and at 70, the same 25,000 today, you will require 3,74,000 at the age of 70. At the age of 80, it will be 7,36,000 per month. It is looking very big amount. It's a simple calculation. I have not done anything. It's a simple calculation at 7%. So it's and if you look back, even we can realize here in audience, whoever are like 50 years old or something like this, because I'm 50-year-old, so I can imagine when I was a child and that 25 paisa was a big pocket money for me. And today, even that 25 rupees is nothing for my child. So that is why after many years we'll realize this. But today, definitely, when I see the 7,36,000 rupees, but you see the difference from 30 years to 80 years means 50 years are there, and we have to accept this. So, example, if somebody expect a life expectancy of 85 years, inflation is 7%, and post-retirement, we do not expect to invest our money in risky assets. So, even if I assume 8% return post-retirement, so inflation of 7% and returns of 8%. So with the inflation adjusted returns, let me tell you, somebody needs around 4.26 crore rupees. So a 30 years old person who has per month expense of 25,000 rupees today should plan to accumulate at least 4 crore, 5 crore rupees. And if your expense is more than this, definitely should have a bigger plan. It is not difficult. See, this 4 crore rupee may look a big amount, but because you have number of years in your hands, and if you understand the power of compounding, this is not difficult. Only thing that you have to start early. Yeah. Sooner you start, easier it is. I will tell you, sometime as Deepak sir said in the beginning itself that people start their planning little late for retirement. You know, you'll surprise though this slide is visible here, so you know the answer also. But if I would ask the question, many would not be able to imagine this. See, if I calculate at 12%, see, I'm not saying that which scheme will deliver 12%. It is an example. If you calculate at 12% and you have 20 years investment horizon, then at 12% to accumulate 1 crore rupees in 20 years, you need to invest only 10,000 rupees per month. But if you delay it by 5 years, you start after 5 years, then you have to invest double the amount. So every 5 years, the cost will double. So if you want to accumulate 1 crore rupees in 20 years, you are investing 10,000, but if you delay by 5 years, you have to invest around 20,000. And if you delay further by 5 years, means instead of 20 years, now you have only 10 years in your hand. Then you have to invest 4 times of that. So even if the returns are 12% or it is 6%, in every case, the purpose of telling here is that the cost is double. So earlier you start, better it is. Even I'm showing here only 20 years. If you say 30 years, even with a smaller amount, you can start. So do not wait that your salary will increase, your income will increase, then you will start investing a big amount. Better start with a smaller amount. Definitely with rise in income, you can increase your investment year after years. One more example you can see here. 1,000 rupees per month saved for 30 years. 1,000 rupees per month, it means in a year you're saving 12,000 rupees. In 30 years, you saved 3,60,000. And for the purpose of calculation, I'm taking different rates. So say 15%, it becomes 56,31,000. The cost is only 3,60,000, but the amount is 56,31,000. But if you start late, say now instead of 30 years, you have only 20 years left for the planning, and you invest 1,000 rupees per month, same 12,000 in a year. In 20 years, you save 2,40,000. So difference is not much. In 30 years, you save 3,60,000. In 20 years, you save 2,40,000. But see the value. In 20 years, the value is only 13,27,000. And if you further delay and you start late and only 10 years are left, so it means you are saving 1,20,000, which is half that of the 2,40,000. But see the value, it is only 2,63,000. It is why? Because of power of compounding. The longer you stay invested, more amount you can accumulate. This is one very interesting example here. There were 3 friends. One friend, he started early. At the age of 30, he started investing 1,000 rupees per month. But because he started early, he had 30 years in his hand. Now say again, assuming 15% return in long term, he saved 3,60,000 what he invested, and the value is 55,66,000. But another friend thought, why so early? I have another goal. I'll go on vacation. I will buy a smartphone, expensive smartphone. I will spend on other gadgets, and later will plan when the income increases. At the age of 40, definitely income went up. And as he thought, he decided he invested 3,000 rupees, means 3 times more than the person who started the age of 30. But because he had only 20 years left in his hand, he invested 7,20,000 more than the person who started earlier with 1,000 rupees. Because now this person is investing 3,000, 3 times. But see the value, it is only 39,35,000. And third person who thought he is the most smart person in the group, he will enjoy his life and later he will start, but he will start with a bigger amount. Definitely what he planned, he did. He started investing 10,000 rupees per month, 10 times more than the person who started at the age of 30. But it was too late. He had only 10 years left in his hand. He saved 12 lakh rupees, but what is the value? Only around 26 lakh. So that is why it is important that start your retirement planning the day you start earning. Start with a small amount, 1,000 rupees, 2,000 rupees, 5,000, whatever your pocket allows. But yes, longer the period, better returns you will accumulate. Anyway, this I have repeated. So these all things, yeah. Now retirement planning, there are 2 phases. One is accumulation, another one is distribution. We have to understand both the phases are important, but yes, when we talk about asset allocation, we talk about choice of investment, choice of products, it will be different. Because during accumulation phase, we can take higher risk. When you're starting your retirement planning at the age of 30, at the age of 25, you have long investment horizon. And at this,
Sorry to interrupt. Your slide has been static, sir. Actually, many.
Yes, sir.
Okay. Maybe stuck. Now, can you see this retirement planning accumulation distribution phase? Yes.
Yeah.
Extremely
Yes.
sorry, there may be a problem. You please keep reminding me or letting me know. Okay. So what happens? There are 2 phases. We all know this thing. We know everything. Whatever I told today, there is nothing new. I understand everyone knows this. But how many practice it? That is the question. This is a good group. Especially in our country, understanding of these all things are limited. But yes, still in this group also, I will try to highlight everything. So we know accumulation phase and distribution phase. In accumulation, because we have a good time in our hand, we can take risk. We can invest in some products where we can expect volatility, but at the same time we can expect good returns. But once we retire or we are near the retirement, then we need to withdraw money regularly. We need a cash flow. At that time, it becomes difficult to take higher risk. Many investors during accumulation phase, they don't take risk or they don't understand the importance of market linked products. And the problem is when they reach to at their retirement age, then they realize that it is difficult now to manage with the money what has been accumulated. So that is why starting early, at the same time, selection of products, that is very, very important. We all know that inflation eats up our retirement. We have seen so many slides. So what is important? Important is diversification of portfolio. See, Deepak sir also highlighted this, and Somit also spoke much about NPS. No doubt, NPS is a wonderful product where you have choice to invest in different asset classes, equity, corporate bonds, government securities, and alternative asset. But along with that, because there are limitations in that product as well, I'll say here, so you should invest in different asset classes and different products. Obviously, when we talk about retirement, see, any individual have different goals. When we're talking about the short-term goals, we can invest in fixed deposit, we can invest in small saving schemes, we can invest in government securities and bonds, debentures, everything. But when we talk about long-term investment, like I said, 30 years, 25 years, when you have that investment horizon, your more allocation should be in equity. So we have multiple choices to invest in equity. It can be a direct equity. You can, if you have knowledge, you have access to research, you can invest in direct equity shares. Otherwise, you have choice of equity mutual funds. You have choice of definitely NPS, because this also gives you opportunity to invest in equity. You have ULIP, though I'll not talk much about that because somehow ULIP, the expenses are much higher. So it's a market link product. Many can compare it with NPS and with mutual funds. But I would like to clarify that because expenses are very high there, so if even that ULIP underlying funds perform well, but returns will be not same as you get with the NPS or mutual funds, only because of expenses, and when expenses are higher. And there are other factors also which makes ULIPs less attractive. But let's talk about that investment choices, marketing choices, as I said. So during accumulation phase, as I said, you can take more risk. You should definitely invest in marketing products and traditional products, as I said earlier also about FD, bonds, debentures, or these life insurance policies, traditional plans, they lack scope of getting good returns. So with 6%, 7% return, it is difficult to accumulate the desired amount. Second, one important thing here to highlight when you talk about long-term capital building, long-term wealth creation. See, today we have many choices, like, people still love to invest in gold. People love to buy jewelries and gold in physical form. But now we have choice to invest in financial assets. Even if you want to invest in gold, you have choice to invest in sovereign gold bond or gold ETF or gold mutual fund. Even if you want to invest in property, you have choice to invest in REITs or InvITs, real estate investment trust or infrastructure investment trust. So the purpose of explaining this is that you have choice of financial assets than the physical assets, which make better sense. So yeah, when we talk about long-term, equity is something which definitely will help you creating wealth. And some who think that equity is risky, equity is volatile by nature. This is true. There can be a risk in equity investment, and volatility is the inherent nature of equity. But if you have knowledge, if you do research, or you take help of experts, the risk can be minimized.
Again, your slide is static, sir. Again, your slide is static.
I don't know what is happening. I'm surprised, but anyway, thank you very much for telling me. Yeah, I think it may be visual. I'm just again starting it and it comes on. Okay, so as I said, sometime when people say that equity is a risk, see, we know the reason why equity is required, because you cannot expect 12%, 14% returns in equity, and with 6%, 7% to accumulate that 4 crore rupees, 5 crore rupees will be very difficult. So that is why one has to understand that equity should be a part of a portfolio. And when we talk about a long-term investment, then definitely it makes more sense and your risk is lesser. But yes, as I said earlier, that for many individuals, equity is a risky asset because they do not understand the risk or they don't understand equity. When you go to a bank and you say, I want to open an FD there, if I ask the depositor that why you want to open an FD, if tomorrow say for example, we take example of public sector bank. If you go to a public sector bank and open a FD, you don't feel risk. You don't consider risk there. You feel that if you are depositing money in a public sector bank, it means your money will come back to you. But when I suggest you, why don't you buy a share of that bank, then people have different thinking about it. See, if you feel that bank you are trusting is a public sector bank, for example, and you know that bank will not go bankrupt, that is why depositing your money there, then buying a share of that bank may also not be risky. Yes, there may be a volatility in that. Prices may move up or down, but if the bank will exist, it will make profit, then definitely your share will also grow. But people have different thinking about when it comes to debt and equity. So anyway, this is just because time is also limited, I feel. Individuals who do not have good knowledge about the equity market, they can take help of NPS or mutual funds. In mutual fund and NPS, what main difference I find is one, when you invest in NPS, one thing, your 100% allocation cannot go in equity. So I feel when you are very young and for other goals, you're investing in gold, silver, debt, real estate, but for retirement, you want to keep the money in equity in the initial years. In mutual fund, you can invest 100% money in equity. The choice is in your hand. So that is one. Second thing, when you invest in NPS at the age of 60, 40% of the retirement wealth, 40% corpus has to be utilized for buying annuity. But in mutual funds, when you invest any point of time, whether you want to retire early or at the age of 60, you can buy annuity as well, because this annuity plan, which you have to transfer money after accumulating in NPS, same annuity plans can be bought with the money you accumulate in mutual funds. So that is why if you make a portfolio where NPS and mutual funds both exist, may make a better portfolio for investor. And mutual fund, the good thing is that you have multiple choices in each fund. Though in NPS also you have choices that you can allocate, but in equity like 75% is the maximum allocation you can have. But in mutual fund you can decide as per your choice. So there are funds right from liquid fund to conservative hybrid fund in debt side, or in equity you can think about arbitrage fund to diversified equity fund with a large cap, mid cap, small cap, multiple choices, sectoral, thematic. So multiple choices are available. So during accumulation phase, you can take a little bit higher risk. You can invest in these diversified equity funds. But when you are near to retirement, or when you are actually retired, after that you transfer your money in some less riskier funds or in hybrid funds, debt-oriented funds, or buy annuity that time, or buy any other product which gives you regular cash flow. And in mutual funds also you have one choice to get regular money, that is systematic withdrawal plan. Systematic withdrawal plan can help you to manage your cash flow, means whatever you accumulate or whatever money you want to keep for your monthly expenses. So instead of withdrawing in one lump sum, you decide that how much money every month, every fortnight you want to withdraw. So your salary stops, but if you have planned well, you have accumulated good amount of wealth, then you can withdraw regularly through SWP even the good thing is that in NPS also, that SWB choice is available now, where you can withdraw your that withdrawable amount, not in lump sum, but in the systematic way. So here, again, as I started with the accumulation phase and distribution phase, so in distribution phase, you may take lesser risk. But again, because whatever amount is accumulated at the age of 60, you have to survive on that money for next 30, 40 years. So that time also, don't think that you will invest that money in fixed deposit or you will keep that money in only bonds. Maybe lesser risk, lesser allocation to equity, but at any point of time, asset allocation is very important. So with this, I will thank to all the audience, and you may have questions on this, anything on financial planning retirement, and I would like to answer your questions.
Thank you, Mr. Matpal. This session we have done in association with the PFRDA. We want to listen from our Mr. Sumit Kumar for how NPS is reaching to the people and how this is really creating a positive vibration amongst the young generations, and especially those who are having their professional activities. They have started from their earlier age, how they could achieve their retirement plan for their future, and how NPA is an enabler. NPS system is an enabler for their life. I request Mr. Sumit Kumar to kindly say a few words on this NPS, sir. Please.
Sir, you're in mute, sir.
I'm sorry. So it's really an honor to be part of this event, which is organized jointly by the ICMI and PFRDA. I'll begin with I think it was very well explained by Mr. Sumit Das, NPS as a product very well, and which he explained, all the features and the products very well. And now from PFRDA side, we are doing a lot of seminars and a lot of things which we can take this product to the masses. So we are doing, because what we are doing is for private side, the government side is mandatory, but for private side, what we are doing is we are organizing events for the corporates through trade bodies and other we are directly meeting the corporates also, how we can propagate this to the different to their employees. And also here with this with this event, we request all the CMAs, if they can take it to the different organizations which they currently are into. So if they can take it to the different employees, and if they can talk to their HR, if they can build this as a part of their salary structure and all that, that will really help in propagating this NPS to the all the employees of the organizations. And the main reason that why I would say that why NPS should be made part of the plan is because, as it was already highlighted, because only PF investing into the PF is not enough. So we need to build additional corpus. We need to have additional plan for the retirement, which NPS would bring that that gap. So which we have seen that as a we have seen that as a survey of one of the consultant, very senior consultant, which says that building corpus using the pension fund or the provident fund alone would suffice. If you continue investing for say 30 years in just using the PF pension fund, it will suffice your that the ratio would, at the end of the when you retire at 60, the amount that the amount of the pension would only be replacement rate would alone would be around 128%. But if you club it with the NPS, it would raise up to 50%, which actually gets close to what the currently the other pension schemes is currently government is also giving. So basically, my request would to all the CMAs who are listening to this event would be to basically to understand this product and also propagate this to the rest of the organizations, to their employees very well. So in case you have questions, we can take this question right now. on the NPS?
Yes, yes, sir. Yeah, we have got many questions. I request Indrakshi to please put up the questions before our esteemed speakers and our, especially we are having our chairman also of the PFRDA. Please, Indrakshi.
Yes, sir. Thank you so much. So, sir, one question is that however, as nowadays there is a tendency among all the employers and sometimes from the employees too to get retired early, maybe post 50 years or around 50 to 55 years. Please guide, sir.
Can you repeat that question, please? Not
Yes,
very
sir.
clear. But can you repeat that question? I think that was not very clear.
Yes, sir. Yes, sir. There is a tendency among all the employers and sometimes from the employees too to get retired early, maybe post 50 years or around 50 to 55 years. So please guide, sir.
You know, if you're planning to retire early, so as had been said by all these speakers, so it is better to start even earlier in that process. So the accumulation, one has to set aside larger portion of the income towards retirement planning, and it could also happen that people go beyond 60. Longevity is also increasing, and in the NPS, we have said that one can really join NPS even up to the age 70. For example, somebody is retiring at 60, you retire with a good amount of accumulation. So people then look around for where we should invest, and longevity has also increased. Immediately, they may not require that money. So suddenly, even people can join at that age, and you can postpone annuity to 75 years. So one knows one's own financial conditions. So these flexibilities have been also brought in.
Can I add to that, Indrakshi?
Yes, sir. Sure. Sure, sir.
See, if I got the question right, basically it's talking about the early retirement, whether a chosen option or because of the change in the economic environment, organization, or something. So I may have planned that as per my biological age, I should be retiring at 60, but circumstances, it can be my health condition because of the organization situation, I choose to retire at 50. Is that the question, right? Correct. So the thing is, when we do a retirement planning, as Chairman PFRD also said, that one product as Mr. Pankaj Matpal also highlighted, one product, one asset class is not good enough. We have to invest in a diversified portfolio of various assets and products. Now, the thing is that NPS, you can get the maximum benefit of withdrawal once you retire at 60. So what if I retire at 50? As a investor, I would not like to I will not be able to withdraw that funds till 60. But that is not the only product I've been investing in. I've been investing in mutual funds. I may be investing in annuities. So I will be using those options, right? And even after retirement, as Chairman PFRDA highlighted, that NPS is a very, very safe product. If I have a choice, I will defer the withdrawal even after 60 so that I can enjoy the compounded returns at a very, very minimal cost. The cost is very important, and I become more cost conscious once I retire. So if like, you would be surprised to know that one of the pension fund managers under the NPS system, in this present bull run, has given a 1 year CAGR of 29%. Now tell me how such a safe product, such a low cost product can generate that kind of a return. We work with NPS, we bring subscribers to the NPS platform, and what we are sharing is not just a theoretical knowledge. What we are sharing is based on our experience of the product.
Thank
I
you.
hope
Thank
I'm
you.
able to answer that question.
Thank you. Thank you. Acha, let me, sir, in your august presence, one of our member has asked one question. Rather, he has given a request that return of NPS is okay, but concerned is today low return of annuity for retirees. My request to PFRD and our institute makes a request to government to reduce the gap of return of FDRs and annuity. That's a simple suggestion from our member that I'm just putting before you. Do you have any say, sir? Could you please highlight on that?
No, it was also mentioned by speakers. See, annuity, one thing that I will say, that normally one can accumulate and buy an annuity. But it makes sense to come to NPS and buy an annuity because GST is not there. So in the normal process, you are buying from annuity provider, GST is there. So straight away one gets that much of saving. Second thing, annuity through NPS, those are exiting from NPS. Exit also what we have made from the PFRDA side is seamless. No additional documentation is required. The exit is done. And there, the annuity rates for people who are exiting from NPS is higher compared to that even the normal market annuity would be there. Because what we have said that you give under the direct scheme, of course mutual fund also has a direct scheme. So benefit again passed on to the customer. Third thing which I would say which is important, that systematic lump sum withdrawal that we have said. For example, somebody is in a equity linked scheme and getting 12 to 13% return. They stay in the scheme first, they dismantle, withdraw that 60% depending on the requirement of the monthly. Still, they are not out of money because this 40% which is there supposed to be annuitized. That annuity can really be deferred to 75. And obviously that 40% over a period of 60 to 75, 15 years would have compounded to more than it stays invested in the system, more than 100%. And so one has a choice from that side. So these are the things and good features in the NPS that which can really balance.
Right, sir. Sir, another question, rather I should say, maybe it would be for you only. NPS charge administration charges irrespective of transactions. For small depositor, it is costly affair. You do have any comments, sir, on this?
As speakers across, spoke, because there is a cost involved. Because I would say that at the entry level, certain charges and all that is there, but incremental charges are very low. And the charges that I mentioned in terms of corpus and other speakers also testified that. So that is on an average basis. But obviously that one would see that if you put a very small amount, so NPS is not the right choice. For that, we have Atal Pension Yojana, which you didn't speak about.
Right.
Which gives kind of assured return of 1,000 to 5,000 pension over a period of time.
Right. Sir, everything.
Another
I think most of the questions have been answered.
Sir, one question: is there any product which can be purchased by people who retire early in life, say at the age of 50?
For the early retirement?
Is there any product which can be purchased by people who retire early in life, like at the age of 50?
You got the question.
No, actually.
Is there any product which can be purchased?
Yes. What I'm saying, that one can really purchase a product. Suppose somebody is retiring at 50, you can get a pension means kind of a fixed stream of income coming. One can get an annuity, and as I was also mentioning, one can even join in 70 and also retire after that, and then can be part of NPS and can purchase annuity also. Right. And see, the other thing happens, that is, it's not necessarily that one will have to go to 60. Suppose it's an employer-employer relationship. There's a contractual relationship. One is on a contract employment for say 3 years. So after 3 years, somebody exits the NPS system, it will be taken as a normal retirement for the person. And then you have to annuitize 40, 60, one has to take a certain. And there's a lock-in period of 5 years. Somebody is in a long-term employment but wants to exit earlier prior to 60. So only constraint there after 50 years, after 5 years of lock-in, if they come out, so only they have to annuitize 80%. 20 can be done lump sum withdrawal. So that's the only constraint. Otherwise, there's no constraint. So it is a flexible product. Age of entry, as I said, is up to 70. So that is what it is.
Thank you, sir. One question has come just now. This is, I think, this is the last question for us. One our CMA friend has asked: do you have any plans for merging NPS and EPF for combined pension and return? It's now member is looking for that.
No. EPFO has a different purpose, and there is also implied, pension scheme, whatever is the small, part of that, because that itself is a recognition that you need a fixed stream of income.
Right.
We cannot withdraw everything at one go. Then it is not going to serve us for the golden years.
Yes.
And EPFO is also no restriction for NPS. See, the statutory restriction is there. Tax experts are here. It is only up to 15,000, monthly income. And current day and age, every employee gets more than 15,000. So there's no compulsion that one would have to really go there. And in terms of corporates, there are many post-retirement benefits they can provide, which becomes exempt in their hand. So obviously, as deductible from their expenditure, and so their NPS also qualifies. So also provident fund and many other retirement benefits.
Thank you, sir. Thank you. Actually, I think most of the questions have been answered by our panelists, and especially I am really grateful to Dr. Mohanty for his continuous presentations, discourse with us, and I'm really looking for, our institute will be looking for more discourse on this matter on NPS to popularize this. Already many, I know that they compared to the last year, this year we have got very excellent response from the citizens of the country, and I hope so that through this process many other people will be joining. Many of the non-CMAs have also joined today, sir. You'll be very happy to know, because we have opened for all these people. So, and you'll be very happy, this YouTube, when this whole recorded video will be posted in our YouTube channel, we have got more than 60,000 subscribers. So naturally, everybody will be looking for that. Those who could not join, they will be listening. And I am sure that in future also, through this sort of interactions, many of our investors, those who will be who are yet to decide on how to in their process of their planning for retirement, they will be more and more concerned, and they will be more and more, rather they'll be sensitized to this sort of programs. I am really thankful to PF for giving their very valuable time for this our effort to connect with the citizens for these retirement solutions. Now I will hand over the session to Indraki and vote of thanks will be given by our BFSI HOD for this particular program. Thank you.
Thank you, sir. So I would request now CMA Dipendra Roy, sir, our HOD, sir, for the vote of thanks. Sir, you're in mute.
Yes.
Sir, we can't hear you, sir.
You are not audible, Dipendu, please. You were audible, please. Yes.
Sir, we can't hear.
He's.
Okay.
Please carry on. You are listening. Thank you. Thank you, sir.
So thank you for the opportunity.
sir.
Look forward to collaboration.
Thank you, sir. Thank you.
Thank you so much. Thank you so much. So, sir, we will end this program with the national anthem, sir. So, I would request everyone to please stand up for a couple of minutes. National anthem, please.
अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you, sir. Excellent program today. Thank you, sir.
So, we are closing this program for today. Thank you so much.